3 years ago, I decided to test something that completely changed how I think about money. I took the same amount of cash every single month and split it in half. One half went into what everyone calls the safe option. The other half went into what people online swear will make you rich. Fast forward 3 years, one of those accounts crushed the other. And the scary part? The loser was the one my parents told me was guaranteed. Today, I'm breaking down the financial advice we were all raised on, why it made sense back then, and why following it today is quietly keeping millennials broke. If you're 25 to 40 and feel like you're doing everything right, but still falling behind, this video is for you. Let's start with the most common advice ever. Save your money in a savings account. Our parents weren't dumb. In the 80s and 90s, savings accounts paid 5, sometimes even 8%. Parking your money there actually grew your wealth. Today, most savings accounts pay around 1% if you're lucky. Inflation has averaged about 3 to 4%. That means every year your money is literally losing 2 to 3% of its buying power. Here's the math no one shows you. Save $10,000 in a savings account earning 1% for 10 years. You end up with about $11,000. But inflation quietly ate away roughly $4,000 of purchasing power. You didn't grow wealth, you went backwards. The modern alternative isn't risky stock picking or gambling, it's broad index investing. Over the last century, the market has averaged around 10% annually. Even after inflation, that's about 7% real growth. That same $10,000 invested instead of saved becomes nearly $20,000 in 10 years. That gap is the difference between staying stuck and actually getting ahead. Which brings me to the next piece of advice. Avoid all debt. Period. Again, this wasn't terrible advice back then. High interest rates, fewer protections, and unstable job markets made debt dangerous. But today, not all debt is created equal. Credit card debt at 20% interest is financial poison. But low interest debt, like a mortgage at 3% or student loans under 5%, can actually be a tool. Here's the real math. If you aggressively pay off a 3% loan instead of investing, you're guaranteeing a 3% return. Meanwhile, the market has historically returned more than double that. Over 20 years, investing that money instead of rushing to kill low-interest debt can mean hundreds of thousands of dollars in missed growth. The modern move isn't no debt, it's smart debt. Use cheap money to invest in assets that grow faster than the interest you're paying. Now let's talk about cars. Buy a reliable used car. This advice sounds bulletproof, and emotionally, it feels responsible. But here's the truth most people ignore. Cars are depreciating assets. Whether it's new or used, it's losing value every single day. The mistake isn't buying used. The mistake is overbuying. I've seen people making $50,000 a year driving a $25,000 car because it's reliable. That car will lose about half its value in 5 years. That's $12,000 gone. Invest that same $12,000 over 30 years at 7% and it becomes over $90,000. The modern alternative is brutal but effective. Buy the cheapest car that safely gets you from A to B. Treat it like transportation, not a reward. The money you don't sink into a driveway ornament is money that can actually compound. Next up, and this one's controversial, get a college degree no matter what. Our parents grew up in a world where a degree almost guaranteed a better life. Tuition was cheaper, wages were higher relative to costs. The return on investment made sense. Today, the average student graduates with around $30,000 in debt. Some degrees still pay off massively. Others don't even cover the interest. Here's a hard truth. A degree that costs $100,000 but only increases your salary by $5,000 a year can take decades to break even. Meanwhile, skilled trades, tech certifications, and self-taught careers are producing six-figure incomes with a fraction of the cost. The modern rule isn't college is bad, it's run the numbers. If the ROI isn't there, it's not education, it's a liability. Finally, the advice that might be costing you the most. Stay loyal to one company, work hard, and they'll take care of you. That was true when pensions existed and companies rewarded loyalty. Today, job hopping every 2 to 3 years increases pay by an average of 10 to 20% per move. Staying loyal often gets you 2 or 3% raises that don't even beat inflation. Let's do simple math. Start at $50,000. If you job hop and get 15% raises every 3 years, you can hit six figures in under a decade. Stay loyal with 3% raises and you're still struggling to crack 75. The modern alternative is strategic movement. Build skills, deliver value, then leverage the market. Loyalty to a company doesn't pay, loyalty to your future does. So let's recap. Saving cash is losing money to inflation. Avoiding all debt leaves growth on the table. Overspending on cars drains your future. Blindly chasing degrees can destroy ROI. And company loyalty quietly caps your income. Here are 3 things you can do today. First, move excess savings into low-cost index funds and let time do the heavy lifting. Second, list your debts and identify which ones are actually hurting you versus which ones are just emotionally uncomfortable. Third, update your resume and see what the market thinks you're worth right now. Now, I want to know, which piece of advice did you grow up hearing that you're starting to question? Drop it in the comments. If this video saved you years of bad decisions, hit subscribe. Every week we break down the money truths no one taught us. And in the next video, I'm revealing exactly how my index fund portfolio beat my individual stock picks over 3 years with real numbers and zero hype.